Now, to finish up our discussion about liquidity ratios, we have a couple that are what we call liability coverage ratios, liability or coverage ratios. And these are, again, they're particularly important to new banks, right? Because these are sort of the first indicators for a new bank about whether the firm has the ability to pay back their loans or to pay off a new loan. So one of the ways you can think about this is these ratios kind of act similar to a credit score on the personal setting. So this is a way to intuit whether the firm has the ability to pay its bills, both in the short term and in the long term. So the first one, and probably the most useful from a bank's perspective, is called the times interest earned ratio. And it's often shortened to its initialism, TIE, or the tie ratio, like TIE Fighter. And the tie ratio is EBIT divided by interest. So this is earnings before interest and taxes divided by interest. If we flip back to the income statement here, we can see EBIT, earnings before interest and taxes, of $694 million, directly above interest paid. So this is our interest expense of $70 million. And the tie ratio says divide EBIT by interest expense. So 694 divided by 70. So again, one of the nice things about ratios is we can kind of do this in our head, or at least we can get an indication of it. If we just round 694 up to 700, then 700 divided by 70 is 10. And so then we can say the tie ratio is a little bit less than 10, right? So let's look at and think about why a bank would care about this. First, again, the easiest way is to look at the extremes and or the common outcomes. So what happens if this ratio is equal to 1? Well, if the tie ratio is equal to 1, that means that EBIT is exactly equal to interest. And that, again, is not probably going to be a good sign for a firm. It's certainly not going to be an encouraging sign for a bank if you're asking the bank for a loan. Look at this income statement again. If the ratio is equal to 1, that means my interest is equal to 694, because then EBIT divided by interest is exactly equal to 1. But that means that 1, I have really, really high interest payments, right, relative to my income. So I have a lot of debt. And 2, it means that I make zero profit. Because if interest is equal to EBIT, then EBIT minus interest is 0, taxable income is 0, taxes are 0, net income is 0. So the firm is not profitable, and that is not an encouraging thing for a firm to be. It also means that there's zero margin for error. A firm is not going to give you a new loan if your tie ratio is equal to 1, because there is zero room in your earnings to pay new interest payments. So we certainly don't expect this ratio to be less than 1. That means the firm's losing money, and that has already triggered some concern among the existing loans, the banks that have, or creditors that have made existing loans. And no new bank is going to give you a loan if you're losing money. We would like this ratio to be greater than 1. In fact, we'd like this ratio to be much greater than 1. And it's pretty easy to say that the higher the tie ratio, the better managed the firm is, and the more ability the firm has to use debt financing in the future. Right? So in our hypothetical example, the tie ratio is 10, and that indicates that there is lots and lots of room for things to go wrong, for revenue to fall, and the firm's still going to make its debt payments. If it gets a new loan, that's unlikely to change as long as the new loan is not enormous. Now, there is some wiggle room in the tie ratio, and that wiggle room is illustrated by what we call the cash coverage ratio. And this is EBIT plus depreciation divided by interest. So again, if we flip back to the income statement, you can see that EBIT plus depreciation, 65 million, this would give us approximately 760 million. And if we divide 760 million by 70 million, we get 10.6. So we get a slightly higher value. And the reason this wiggle room exists is because, again, if you think back to the lecture from chapter 2, depreciation is not a cash expense. It is an accounting expense. Depreciation is a way for us to slowly reduce the value of our purchased assets and keep our book value and our market values relatively similar It's a way to match the cost of assets to the revenue generated by assets. It's a lot of different things in accounting, but what it is not is an actual cash expense. I am not spending $65 million on depreciation. Because of that, it means the firm has $65 million in cash extra. And that is the wiggle room. Even though my accounting statements say that I don't have that money, I actually do. Right? That's what we call an accrual. But that accrual means that there is some wiggle room. And so the cash coverage ratio is often used as sort of a stricter measure, or maybe a less strict measure, of the tie ratio, in that it gives the firm the ability to forego depreciation in order to make sure that it can always make its interest payments. Okay? So again, the interpretation here is the same. We want this ratio to be big. We want EBIT to be much larger than interest. Not necessarily depreciation, but EBIT. And if this ratio is close to 1, then the firm is in significant accounting trouble. If it's 1, it means that the firm is actually losing money in an accounting sense, even if it's not losing money in a financial sense. And those are two different things. Now, the next set of ratios is what we call management and turnover ratios. And these ratios are attempting to ferret out and to help us understand the efficiency of the firm's operations. Is the firm being managed well? Are the assets being used efficiently? And there are a couple of different ways that we can tease this out. The most common are right here. The first one is called the inventory turnover ratio. And one of the ways to help you remember the turnover ratios is that whatever the name is that's being turned over, that is always on the bottom of the ratio. So inventory turnover always has inventory as the denominator. Receivables turnover has accounts receivable as the denominator. And total assets turnover has total assets as the denominator, right? Finance is not super clever with naming. We always tend to pick names that are very representative of what's going on. So that will always help you if you're trying to remember something. It's usually not a trick. It's usually telling you exactly what's going on. So inventory turnover ratio is cost of goods sold divided by the average inventory. And remember, inventory is product that we hold in a warehouse that hasn't been sold yet. And it's typically similar. In other words, there is an inventory strategy that firms use, and they try to maintain a balance in their inventory so that there is enough to handle a surge in demand, but not so much that they just have unused products sitting in a warehouse forever. Right? So a firm is trying to strategically think about inventory so that it is producing and has some backup in case things go crazy and everybody falls in love with their product, but not so much that they just have products sitting there for too long and they just have spent all that money on supplies, but they're not recovering it from sales. Okay? So if we think about what this ratio implies to a firm in terms of efficiency, what it's telling us is precisely about this strategy of inventory management. Right? So cost of goods sold is the cost of building all the product that goes into inventory. And if this ratio were, say, to be equal to 1, it would imply that we build all of a product that we sell in the year, we hold it in inventory until we have finished all the product, and then we sell it all at once. And we only do that one time in the year. Right? So a ratio that's, say, equal to 1, imagine that we're running a bike shop and we sell just 10 bikes a year. So we make really, really, really fancy bikes. We only sell about 10 a year. But the way that we do it, if this ratio is equal to 1, it implies that the way that we do it is we build all 10 bikes and then we sell them all at once. And that's the only thing we do during the year. Right? And it's not that that necessarily indicates that we're doing a bad job or that we're being inefficient, but it does indicate a strategy that we want to question and think about. Right? For instance, the alternative strategy would be for that ratio to be equal to 10, because that would imply that we build one bike and sell it. And then we build one bike and sell it. And then we build one bike and sell it. We're building to order. And if we're building so few bikes, then it makes more sense probably to build them to order. There isn't likely to be a scenario where we are in the position to need a bunch of bikes in inventory. And if we're only selling 10 a year on average, then why do we have 9 bikes sitting in our inventory for a year and not just being sold right there? Right? In other words, we could improve our management of our short-term cash situation by only buying the supplies for one bike at a time. then the sale of that bike could help us buy the supplies again. If that's not the case, we've got to buy the supplies for all 10 bikes all at once. And that might be a sort of more difficult financial position to be in. Right? So inventory turnover tells us how that strategy, what the strategy for the firm is in terms of buying supplies, making inventory, and selling it. And a ratio that's high means that we are turning that over relatively quickly. We're buying supplies, we're building a small number of whatever product we're making, and we're selling it, and then we're doing that again multiple times throughout the year. And again, we don't necessarily want to have lots of inventory on hand because it's costly to buy the supplies and then not have sold the product yet. Okay. Now, receivables turnover tells us something similar, or it's a similar idea, but it's more about the efficiency of how we sell our product rather than how we build it. Right? So receivables turnover is sales divided by accounts receivable. And again, those are coming from the balance sheet and the income statement. And what this is saying is it's trying to get us to understand the strategy that a firm uses in terms of selling the product that it does. Right? And that strategy is about whether a firm sells product outright or whether it sells product on credit. If a firm sells product on credit, then its sales, those sales on credit, go through its accounts receivable. In other words, I build a bunch of bicycles, I give them to a retailer who then sells them and promises to pay me in 30 to 60 days. So the retailer is hoping that they can get the product on a loan, sell it, and then give me the money, and they don't have to be the one that puts up any of the money up front. They then lower their risk significantly for selling the bikes. For me, I take on a little additional risk if I sell on credit, because of course I don't have the money, and if the retailer doesn't sell those bikes in 30 to 60 days, and they don't have the money forthcoming to pay me, then I have to sort of engage in maybe even some legal maneuvering to get my money, right? So I'm only going to sell on credit if I'm really confident that whoever's buying my product is going to be able to pay me. Although there are lots of different strategies here. So it's not necessarily better to only sell product on outright, and it's not necessarily better to only sell product on credit. There are different strategies involved. And so, for instance, a firm like Walmart has a lot of power over the people, over its suppliers, and it strictly buys things on a receivables basis. So Walmart, if you want to sell through Walmart, you have to be willing to accept Walmart's terms that they will only take your product on credit and pay you once they've sold it. And of course, that is a very, very good strategy because Walmart's one of the biggest retailers in the world. So if you can get your product on a Walmart shelf, the chances that you're going to make a lot of money are pretty high. The problem is that then you have to build a ton of product on credit. You don't get any money to offset that, and you have to provide it on Walmart's schedule. So some firms use lots of accounts receivable, some firms use almost none. And what sales divided by accounts receivable tells us is what that strategy is for the firm. So for instance, this ratio could be 1, and that would mean that all of the firm's sales are on a receivables basis. And this ratio could be really, really high, and that would reference that the firm either made very low receivables, so sold not very often on credit, or sold lots of things on credit really quickly. So they sold a bike, and then they got paid the next day. And they sold another bike, and then they got paid the next day. And that's probably not very common. Remember, firms sort of tend to have 30 to 60 days to pay off their receivables. So we expect this ratio, even if a firm is using receivables pretty stringently, we expect this ratio to be greater than 1, and probably in the ratio, in the range of 12. That would tell you that the firm is converting every 30 days. Okay? So they're selling, their product is also selling, and they're getting paid back in a good measure. So this is sort of a holistic measure of the sales and how the firm thinks about sales and what kind of business they run.